This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest, your daily breakdown of the news that matters. I'm Christine Stewart.
And I'm Mike Savino. And Christine, before we get started, let me wish you a happy birthday.
Thanks, Mike. I'm actually celebrating refinancing my home at the end of March at 4%. What I don't know, or what I'm confused about, is who I pay. I think the loan was sold to Freddie Mac, but I think I'm still supposed to pay the mortgage brokerage.
Yeah, I don't think you're alone. I think a lot of customers are confused here, and that might be one of the reasons that the CFPB continues to monitor whether or not mortgage servicers are doing enough to help their customers. In fact, a new report from CFPB found that the biggest challenge customers had was their inability to reach or get a timely response from their mortgage servicer's call center.
Homeowner is not the customer of the servicer. They don't have the ability to fire that servicer, and that means that market power is a recipe for problems, and we need to make sure that the servicers are being responsive to homeowners.
Other problems included many borrowers getting out of a COVID-19 hardship forbearance without a mitigation launch solution in place, lenders not getting information on a borrower's preferred language, and companies relying on systems that don't give them high-quality data. The CFPB has been focused on mortgage servicers during the pandemic, and this is the agency's second report in the last year.
The good news is that the percentage of mortgage loans in forbearance dropped below 1% in April. The total number of loans in forbearance dropped 11 basis points from 1.05% in March to 0.94% in April. The MBA estimates that 470,000 homeowners are in forbearance plans. The best indicator of loan performance is overall national employment. The U.S. unemployment rate is still below 4%, leaving borrowers in a good position to make their monthly mortgage payments.
In other news, a new study by LexisNexis Risk Solutions found that a large majority of firms reported an overall increase in fraud over the last 3 years. Identity verification was the biggest challenge for mortgage originators, and it comes at a cost due to the extra labor for detecting it. Banks had the highest costs. The study found that every dollar of fraud cost them $5.34, and for mortgage lenders, it cost an average of $4.66 for every dollar of fraud.
And finally, President Joe Biden is drawing praise from both builders and lenders on his plan to bring down housing costs. Biden says his plan will bolster a housing market that has been undersupplied for years. Some of the key elements of his plan include building more rental units for low and moderate income families, expanding existing forms of federal housing, ensuring government-owned homes go to the occupants, not investors, and addressing supply chain issues. Biden wants to finish construction on the most homes since 2006.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.